All right. Good morning. Welcome back to the continuing lecture in Principles of Finance. Today we are continuing with our discussion on bond valuation, and today's topic is today we are continuing with the example of rational price valuation of rational price, or fair value, or intrinsic value. So just to quickly recap what we did last time. Excuse me. We discussed the coupon bond valuation model, and also prior to that we discussed zero coupon bond, right? Zero coupon bond valuation model. Now, so our next example was quite straightforward. Our last example was quite straightforward, but let's take a look at our next example. The Emory Corporation issued an 8% 25-year bond 15 years ago. Now, 8% issued an 8% bond. That means the coupon interest rate is 8%, right? That's what it means. And the maturity of the bond is 25 years. So 8% coupon means 8% of the $1,000 face value. So it's $80 interest every year, right? 25-year bond. That's the time to maturity, but that was 15 years ago, right? So they issued this bond 15 years ago. That means 15 years have passed. And what's the time? How much time do we have left until its maturity? Now, that means we have 10 years left, right? So our time will be 10 years. Of course, since the bond is paying coupons semi-annually, our timeline will be 20 semesters, right? At the time of the issue, it sold for a par value of $1,000. So once again, this is a clue that can help us. This is a clue as to what the sale price and what was the discount rate at the time, because the fact that it's sold for a par value of 1,000 means what? Remember what makes the bonds premium bond or discount bond? Remember that? This is not just the first time, right? This is not the first time you're facing this. This is at least third time, because we talked about this. The first time you heard about this was when we started on the return on investment, the first topic, right? So at the beginning of the semester. And as we came back to as we started on this bond valuation, then it was discussed once again. So that was the twice, and this is the time. So briefly recapping what makes a bond a premium bond or discount bond, or otherwise, you remember it's the discount rate, right? Remember, if the discount rate and the coupon interest rate are the same, then the bond sells at par value, right? If the coupon rate is better than the discount rate, then the bond will become a premium bond. And if the coupon rate is lower than the discount rate, it will become a discount bond. So then this from this you can already tell that the because when it was sold, that was 15 years ago, right? When it was sold 15 years ago, it was a par value. It sold at par value, right? So that means at the time, the discount rate must have been 8%, right? Now, comparable bonds are yielding 10% today. So this is the way, one of the three ways it is worded, right? I've been telling you, they never say this is the discount rate. They never say use this as the discount rate, right? But this is the way it is worded. Either the comparable bonds or similar bonds are yielding 10%, or the prevailing market rate is 10%, or the bond is priced to yield 10%, right? Those are three ways it is worded, right? They never say discount rate is 10%, okay? That cannot be actually, because discount rate is not uh, discount rate is not given. It's not given or born with the bond, right? Discount rate changes all the time. And why does it change? Because the market interest rate changes, and together with the market interest rate, every interest rate in all classes of risk, right? Uh, think about it. The bottom line of all interest rate for short term is Fed funds rate. And as Fed funds rate changes, all interest rates change. And the baseline for the long-term interest rate is 10-year Treasury note. And as the 10-year Treasury note yield changes, and of course the yield on 10-year Treasury note, anything will change because of demand and supply, right? Because of the demand and supply situation for 10-year Treasury note, right? Yield on the 10-year Treasury note will change constantly. And as it changes constantly, right, the long-term bond yield also, long-term bond yield changes constantly because the demand and supply will change. Now, when they say comparable bonds, I've been telling you, comparable bonds or similar bonds mean what? The comparable bonds or similar bonds. Comparable means comparable risk. Similar means similar risk. The bonds of similar risk, comparable risk, right? So that means what comparable bonds, the bonds of the comparable risk pay on average is 10%. Okay. So from this, you can already tell, right? You can already tell previously it sold at par value. 15 years ago, when the bond was issued, it sold for par value of 1,000. So we could tell that the discount rate at the time was 8%, same as the coupon rate. But today, the discount rate is 10%. So then what can you tell about this bond? Is it a discount bond or is it a premium bond today? It's going to be a discount bond. Of course, it goes without saying, right? It's going to be a discount bond. right? So assume the bond pays interest semi-annually, and yeah, that's normally the case. That's how. So calculate the bond's current yield. Okay. Um, so this is a two-part question, right? Isn't that two-part question, right? Part A. So what's the price of the bond today? That's part A. And part B, calculate the bond's current yield. So what is a current yield, right? That's part B. So I already set it up here like this, but let's do this on Excel. So I'm gonna, this is the, okay, I'll have to stop sharing the, okay. Now you see the, this Excel. Okay, let me go back and, applications screen. Okay, here. So you see the Excel file now. Okay, so there are a lot of examples, but the example I'm going to be using will be this one. We can use this one. So I'm going to delete this, and we'll change some data. First of all, the coupon rate, right? The coupon was IC, right? Coupon interest rate. I'm gonna. That was 8%, right? There you go. So face value is 1,000. Coupon rate 8%. And compounding is semi-annual, right? Because pays interest, semi-annually, right? And then, so coupon payment is automatically calculated, right? This times this divided by 2, right? Time left. What's the time left? 10, it was 10 years, right? Was it? It was 10 years. Now, because the bond was issued 15 years ago, and it was a 25-year bond, so we have 10 years left. APR is, of course, the prevailing market rate, right? But we're going to change the name to YTN, yield to maturity, right? Or just yield. Okay. Okay, that means the comparable bonds are currently yielding how much? 10%. Okay. So now half-year rate would be 5% because, of course, you all know we are dealing with semi-annual frequency. So half-year rate, right, would be 8%. I mean 5%. Now, the notation here is price of bond, but I reserve this notation for market price, but we are trying to find the intrinsic value of the bond. I mean, not the market price, but the intrinsic value, the correct rational price or the fair value. Okay, so for that, I use B as the symbol or the label for so anyway. And then how do we find the um, intrinsic value of the bond? So it's first of all the annuity, present value of annuity. So payment over R minus payment over R times 1 plus R raised to N, right? Close parenthesis. And then we need to find the present value of this face value, $1,000 face value, or maturity value, or par value, right? So R raised to 20, right? There you go. And you hit enter, comes to 875.38. Okay, it's 875.83. And then that was part A. What was part B? Part B was what is the current yield? So the current yield is, let me find current yield first and then explain. Current yield is also called the short-term yield. Short-term, right? In other words, what's the and you all know short-term is the maturity less than 1 year. So that's what 1 year is, the line. If you draw a line between short-term and long-term, that line is drawn on 1 year. So anything that has longer than 1 year maturity is long-term. Anything under 1 year, short-term. So current, and I told you current yield means short-term yield, and what is the maximum you can earn within the short term, within 1 year, right? The maximum you can earn within 1 year is basically 1 year coupon, isn't it right? Maximum you can earn, and to earn that two coupon, right? So 1 year coupon, and but to earn the 2 coupons, right, you have to pay the current market price, right? Now, the interesting thing is, this is rational price, or rational intrinsic value, or rational price, or fair price of the bond, which may not be the same thing as the current market price, because the market is prone to overprice or underprice, in other words, misprice any asset in the short run. The market will be usually rational in the long run, but in the short run, market is irrational. right? So it can be pricing irrationally, or it can be mispricing. So in the short run, they may not be the same, but if the market is in equilibrium, of course, in economics, equilibrium comes only in the long run, right? But if everything is in equilibrium in the long run, but if, let's say, the market is in equilibrium by any chance, I mean, if all things are all, conditions surrounding the market is perfect, right? Then, the market, even in the short run, the market price can be the exact price, the fair value, right? If there is a perfect information symmetry, if there is and the perfect information symmetry means there is no delay in the information that gets priced in. Usually, there's an information asymmetry between the buyer and the seller, right? That's why not only between buyer and seller and the company and the market, because the company, there is inside information always, and that's why inside information is called privileged information, right? The market doesn't have the inside information. The market is, and that's the way it should be. I mean, if there is a inside information, nobody should be acting upon inside information. Nobody should be trading on inside information, right? Because that is, of course, uh, that is not fair market. If only a privileged group has insider information and trading based on insider information, right? So anyway, in the short run, it's not likely that the rational price or intrinsic value was the same as market price. But if we assume a perfect universe, right, there is no information asymmetry, there is no delay in the privileged information getting priced in. So the market price would be the same thing as the rational price. So then what did I say current yield is? Current yield is the 1-year annual coupon payment over market price. So our annual coupon payment is, we can do it by 2 times 40, or simply, right, 1,000 times 8%, and then over market price. Okay, and there you go. If you give it percentage, right, give it 2 decimal places, always 2 to 3 decimal places, right, at least. All right, so that's the current yield. Okay, so we answered that question, and let's check our slide. Okay, go back and stop sharing and go back. All right, there you go. So we got 875.38 and current yield of 9.14. Oh, you might wonder. Also, Professor, why is it in red font and in parentheses? Doesn't that mean negative? Yes, it means, I told you, red font, of course, minus sign or red font or the numbers in the parentheses means they mean negative, but in a financial calculator setting, negative means cash outflow, right? So this means I used Excel's built-in function to find it, and because in a financial calculator setting, one thing has to be cash inflow and the other thing has to be cash outflow. And here, of course, this has to be cash outflow, right? Because to receive this future value, to receive $1,000 in the future, right? And all these coupon payments for the next 10 years, right? Uh, and 20 semesters, which are all cash inflows. Today, you will have to pay this, right? And paying this amount, that's cash outflow, right? That's cash outflow. So I'll show you how you can do that in Excel's built-in function later. Let's move on to the next topic. Next topic is call provision. What's call? What is call? Now, call is an option to buy, and the opposite of call is put. Put is an option to sell. Now, this is usually more relevant in the stock market. In stock market, there are options and futures. Futures means futures market, right? Trading assets for delivery in the future, right? Or options. Options are these are all called derivatives, right? Because it's values of these derivatives are based on the underlying asset, right? And their values are derived from underlying assets. So hence it is called derivatives. And two of them, there are lots of derivatives these days. In other words, they have been very creative in deriving assets from the deriving new securities or new derivatives from the underlying assets. But the uh, traditional and most traditional two of those derivatives are, and most common of those derivatives are options and futures, right? Now, options are either call options or put options, right? Call and put are two types of options. And as I said, call is an option to buy an asset. In this case, let's say stock at a pre-specified price if certain conditions are met, right? Also, put is an option to sell a stock at a pre-specified price if certain conditions are met. So in case of coal, suppose you're trying to buy Microsoft, and currently Microsoft is selling for $150. That's the market price. But you believe $150 is market price is overvalued. 150 is, you think, it's overvalued. So that's irrational because it's just you believe it's a short-term phenomenon, right? So and market is, just, exuberant, excited about Microsoft. So too much demand. There's too much demand. right? That's why the prices, uh, you know, uh, prices, unnecessarily too high. It's, hyped. Price is hyped. The market is, on a hype, right? So uh, you're betting that you're betting that the market is gonna sooner or later, when the market comes back to senses, then they will realize the price was overheated. So with the realization, the price will come down, the market will cool off, right? So you are waiting for that timing, and so you're waiting for the price to come down to 140, right? And if the price comes down to 140, then you're going to buy. Now the problem is, here's the problem. If all things, what if things work as your scenario, right? Then it will be wonderful. If the market cools off and the price comes down, then you will buy at 140. But what if the market doesn't cool off? What if the price doesn't come down? Hmm? You've been waiting for a week, for a month, and the price didn't come down, and rather the price went up to 160, and it keeps on, it keeps on going, right? Then what will you? I mean, you of course you will regret, right? You're gonna regret not having, taken up the advantage of the opportunity, right, when the price was 150. That was still a lot of people, waiting, timing, right? Waiting for the right time to buy. A lot of investors, right? Wait for the right time to buy, usually make the same mistake. They miss that, the right uh, timing, right? So that's why you buy, you use, call options. If you buy call option, right? That means, well, of course, you have to pay. It's not for free. You pay. Let's say the call is $10, right? That means, you're buying a call, and that gives you a right to buy um Microsoft at a pre-specified price, which is, let's say uh, uh, 150, right? Or I'm sorry, a 140, because currently it is 150. It's one. Uh, you pay $10, and then if the price comes down to 140, then uh, you exercise the option and buy Microsoft for 140. But actually, this is effectively costing you 150, isn't it right? Because you paid $10 for call option, right? So effectively, for your call to be in the money, right? Meaning, for you to make money out of this, uh, uh, if the price of Microsoft goes up above once 150, then from that point on, you're in, right? Because if it is, 151, right? You're buying, uh, Microsoft for 140, but you paid effectively 150. So from if the price is 151, from there on, you're making, you're saving, you're making $1, right? If it sells for 151, and if the Microsoft goes up to 160, you're making $10. I mean, in other words, you're buying it cheaper, right? Uh, by $10, right? So as the price goes up, right, you're in the money, right? Coal has more value as the price goes up, right? But think about it. You can instantaneously make money. For example, if uh, Microsoft is 160 and you buy Microsoft for 140, right? But because of the call, you paid effectively 150. Now you can sell Microsoft in the market for 151, right? By selling it for 151, because the market price is, I mean, or you don't have to, because market price is already 160. I'm sorry, you don't have to sell it for you sell it for 160, and you instantaneously make $10, right? You instantaneously make $10, right? If you sell it. And if it goes up to 170, then you make $20, right? So anyway, that's the concept of call, right? It's the right to buy. Of course, there's a expiration date. It's not forever. It could be 1 month expiration date. Expiration can be in 1 month. You could be 2 months, or uh, 3 months, but usually 1 month. And then the next question is, if you're buying coal, that means there must be a seller of coal, right? Someone who sells coal, right? Now think about it. Why would someone sell the coal? Well, the coal seller is also called coal writer, right? They say uh, it's called writing coal. They write coals, right? Those who write coals or sell coals are betting exactly against you, right? In other words, they are betting the Microsoft. Uh, they are betting that Microsoft will not go up, because if it goes up, right, uh, you will exercise that option, right? And then the coal seller will. The coal seller has the obligation to deliver Microsoft to you at $140, right? Makes sense? So, and if actually if the price falls, then what happens? If actually the price falls, you won't exercise the option. You will just let it expire without exercising, because now you can buy Microsoft at 140, right? And since the option will just expire without exercising, the wholesaler won't have to buy. Uh, they won't have any obligation to deliver Microsoft to you. So they just make $10 out of this. So that's why they sell coal, right? And you buy coal because you're hoping that the price would come down, but you want to hedge against the other possibility, right? Of Microsoft going up, right? So then the put is the opposite concept, right? Put is the option to sell. If you already have Microsoft and you don't if you sell when the price goes down, you realize loss, right? But to hedge against that possibility, you want to buy put options. So you can still sell at a pre-specified price, even if the price goes down, market price goes down. But anyway, we're not going to talk about the put at this time. But and I told you, put and call are basically stock options, right? Stock market options. But what is put in the bond? Um, what is the call in the bond? Call means the right to recall or buy back the bond. Okay, so it's an option. It's still an option to buy back or recall the bond. And who recalls the bond? Of course, the issuer, issuer of the bond, right? Now you have to distinguish between the issuer and the seller of the bond. Why? You might think issuer isn't the issuer the seller? Yes, issuer is the seller, but only when the bond was first issued. Make sense? Which is called the primary market. In the primary market, the issuer is the seller, right? And what is the primary market? Primary market is when any security is first born and sold, right? That's the primary market. And after that, the trading happens only between the investors. Makes sense? Not between the company and the investors. But after that, the trading is between the investor and investor. Isn't that right? That's called the secondary market, right? When the securities are born, right? The securities are sold by the company to the investors, right? This is the first round of transaction, first round of trading. And in the first round of trading is called primary market, right? So in the life of any asset, any securities, primary market exists only once, right? Like the virgin voyage of a ship, right? And after that, it's no longer, um, and then, after the primary market, everything is secondary market, right? And the transaction happens, between the first round buyer of that security and the next buyer of the security, and so on, right? From the second round buyer to the third round buyer, all these transactions are called secondary market. So why does the issuer, the company, call the bond? Uh, there's a simple reason. The company the company calls the bond if the prevailing market rate falls. Now, think of it. Let me give you an example. So, not all the bonds are callable, right? First of all, only the callable bonds are callable, right? The bonds that are born as a call bonds are callable, right? The bonds, other bonds that are not born as a callable bond, they cannot be called, right? Because they are not callable. And how do you know if the bonds are callable or not? You have to read carefully the indenture. What's the indenture? Indenture is like the contract of the bond, right? It details everything about the bond. What is the coupon rate? What's the maturity, right? And whether it's callable or not. But usually that clause about the callability is usually hidden or in fine print, right? In fine print. It's hidden from the plain sight. And sometimes the clause is convoluted, right? So it's not easily it's not very straightforward. It doesn't easily stand out. It's not like declaring, "Hey, look at me, look at me," look at me. I'm the clause about the callability, right? No, it's not doing like that, right? You shouldn't. I mean, if you think everything is that straightforward, you're being very naive, right? Um, if you think insurance companies will pay 100% of your loss, you're being very naive, right? You have to understand the world is not that naive, and right. If you're a college student, by now you should have known that the world is not that naive. They are all just trying to fend off for themselves only, right? Nobody's fending off for yourselves, right? You have to, for you, so you have to fend off for yourselves. In other words, you have to make everything impeccable for you. You have to have everything written out for you. In other words, you have to have the paper trail of everything, right? Maybe until um, in this country, right? Maybe until high school, everything you could have lived, thought, naively, oh, if I don't do this, somebody else will clean it up after for me, or irresponsible. You become very irresponsible because you are not doing your due diligence. But you have to realize that in the real world, you don't do your due diligence, that accountability falls upon you, right? In high school cafeteria, if you drop your lunch tray, things fall, the corned beef, everything falls on the floor. Somebody comes after you and cleans after you. You never become an adult then, right? But in the real world, nobody comes, you can't, oh, nobody comes after you. Nobody comes for you to clean after you. You have to clean after yourself. It's a common sense. And that's the way, any accountable person with, any responsible person with sense of accountability will behave. You don't cry out, oh, professor, I didn't know. You are supposed to know. That's your responsibility, and you should do your due diligence. Everything was, you check, the announcement section, it's all there. You just didn't do your due diligence to read it and act accordingly. And if you didn't do that, that's your responsibility. You're accountable for your failure then. You understand? You might say, I went, I went to Olive Garden, I spilled some food, they came to clean after me. I don't have to. Look, they are taking money from you, right? They are, you know, so they do that, right? I mean, it's only, you're paying for that service, right? But otherwise, you're not paying for that service, right? You have to, if you, if you don't do your due diligence, right? Um, you take the accountability, okay? And then also, so think about it. In um, so in the indenture, which is the contract, bond contract, right? You have to read every clause, right? Uh, Even the fine print, right? Uh, you have to the ability to stick to the details, the ability to not to miss anything, right? Uh, Nothing should be loosey goosey, right? Nothing can be loosey goosey. You don't let you have to be. That's why I'm always telling you all the instructions are very specific, and you have to follow the instructions to the letter, right? And execute that instruction to the letter. Otherwise, and that's the reality, right? Insurance companies will not pay the 100%. They will try their best, right? If you got into a car accident, they will try to pay the minimum. You should be prepared to fight to get, maximize your benefit from it, right? And to do that, you cannot be loosey-goosey. You cannot be that complacent. You cannot have the loose mentality. You have to have that. You must have a very strict, disciplined, regimented mentality, and that's what you form. That's what you get from the training like this. It cannot be formed just naturally. For some people, it is natural, but for most of you, it's not natural. It has to be trained. You have to be trained to instill that kind of mentality in you. Exactitude, regiment, discipline. So anyway, back to call provision, right? So some bonds are born as callable bond, and some bonds are not. And if they are callable bonds, now think of it this way: why do they issue callable bond? For example, let's say currently in the economy, the interest rates are very high. For example, the average market rate is, let's say, 10%. That's a very high interest rate. And your company is like triple B. You understand? You remember triple B credit rating means the minimum investment grade, right? So if your company is triple B, then you must pay better than the average market rate, don't you think? You cannot pay the average market rate. You should be paying better than the average market rate uh, to be attractive to the investors, right? So let's say then your coupon rate is, so you're selling, $10 million worth of bonds, right? $10 million means roughly about 10,000 bonds, right? And your coupon rate is 5%. And let's say this is a 20-year bond, 20-year. So that means for 20 years, you'll have to pay 15% interest every year, right? 15% of $10 million is like $1.5 million every year. That would be a huge burden, right? You don't like, I mean, that's a huge burden, but what choice do you have? That's the only way you can sell bonds, right? Okay, it's been 5 years since then. What does that mean? Still, 15 years are left, right? And then in year 5, let's say suddenly the interest rate in the market, average market interest rate, has fallen to 5%, from 10% to 5%. So that means average market rate is 5%. But then what would you do if that's the case? Hmm? Aren't you going to be, I mean, you have still 15 years left and you will still have to pay 15% interest. And obviously, you're not happy with that, right? But overall interest rate in the market has gone down. Average interest rate is now 5%. Aren't you going to be thinking about doing something to alleviate your interest burden, right? In other words, um, think of it this way. If you pay back all that $10 million, right? Now, if you pay back $10 million, then what can you do? I mean, you can borrow $10 million again now at a lower interest rate, because currently the average market rate is 5%. Maybe now you can borrow at 8%, right? Previously, when average market rate was 10%, you had to borrow at 15%. But since overall market rate is lower, now you can borrow at a lower rate, like, about 8%, right? And you still have, like, 15 years left. I mean, you can borrow $10 million again at 8% for the remaining 15 years, or you can borrow again for 20 years, right? Another 20 years. I mean, still, you have, interest savings, right? You save a lot on your interest burden, right? Makes sense? Hmm? If that is possible, wouldn't you do that? Yes, you would do that, right? So that is called, in bond terminology, is called refunding. Refunding means, uh, for you, refunding means, getting your money back. Yeah, that means that also. It means that too, because the investors are getting their bondholders are getting their money back. But it also means you are funding again. You're funding your project again, right? At a new interest rate, right? Those $10 million was needed to fund a project or several projects, maybe multiple projects or a single project. But those you are refunding those projects. So it's called refunding, right? But in everyday language, it is also more commonly known as refinancing. Refinancing. What is that? What does that mean? Yeah, refinancing. Literally, you're financing again, right? And refinancing is used usually in what context? In real estate context, isn't it right? Real estate context. Why? Uh, that means borrowing again, right? Why? What does that mean? Well, you have a mortgage, right? You have a mortgage, and with the mortgage, you bought a house. This doesn't apply only to real estate. I mean, it can be used in car financing as well. When you got the mortgage loan, the average interest rate, average market rate was very high. Let's say like 10%. And your um, credit rating wasn't that good, so you could only borrow at 15%, right? So you bought a house. It's a 30-year mortgage. So you've been paying, like, 15% interest on the loan. And then suddenly, in year 5 or year 10, suddenly interest rate went down drastically, like 5%. Isn't this an opportunity for you to refinance, right? In other words, you pay back the old uh, lender, right, and borrow from the new lender, right, at a lower interest rate. So you're going to be uh, saving on the interest expense, right, from now on. But here, the interesting thing is, and also this is the beauty of it. You think you would be thinking, right? If you think about refinancing or refunding, I mean, calling back the bond, you think, oh, you will first have to cough up $10 million, cough up $10 million from your own pocket, from the company's pocket, own pocket, right? To pay back first, and then, first of all, it's going to be a huge burden even for a profitable company to cough up, just, out of blue, just, what, $10 million out of their pocket. Besides, to cough up $1 million, $10 million, that's going to make a big dent on the company's, projects, right? But the in what happens in reality is that none of your actual funds are needed. You don't have to dig into your pocket to pay out 10 million. That's the beauty of refinancing. Um, what you can do is uh, you refinance first, right? In other words, in case of this company, right, the company sells $10 million worth of bonds first, and now 8%, right, for the next 15 years or 20 years. And then what happens? $10 million come in, right? Because they buy the bonds. So $10 million come into the company. And with this $10 million, what do? You call the bond and you pay off the old bond holders and you say goodbye to that, 15% interest rate. Make sense? That's how it happens, in refinancing or refunding. None of your own money is needed. You're simply switching the old bondholder, old lender with the new lender with the new lender's money. Make sense? Okay, so that's call, that's refunding, right? Now, another thing is, think about it. If the call happens, right? Of course, call cannot happen anytime. I mean, if the call can happen anytime, let's say even hypothetically, you bought the bond today and the call happens tomorrow. The bond is called tomorrow. I mean, if it is that uncertain, if it is so erratic like that, how can you invest in such a bond, right? You haven't even recouped your first interest. You haven't even got your first interest paid. Excuse me. So there is, first of all, there is call protection period, right? The call protect, if it is let's say first 5 years, something like that, right? Or depending on the maturity of the bond, right? The call protection period can vary, but for example, for the first 5 years, the call they cannot call. Right? That's call protection period. So at least your 15% coupon interest is guaranteed for a certain number of years. Second, when the bond is called, that means let's say the call protection period is 5 years, and the remaining 15 years are still remaining. So originally the maturity was 20 years, and the first 5 years of the call protection period. So from the 6th year, they can call. And so it is year 6 now, 6th year now, and the bond is called. That means what? From your perspective, right? From the bondholder's perspective, you're going to be foregoing or missing out on the 15% interest you could have earned for the remaining 15 years, right? Although you're getting your principal back, the face value, right, $1,000 back, but you are missing out on the remaining coupon payments. So, but this is not for your own convenience; it's for the benefit and convenience of the issuer, the company that sold the bond. So then, what has to happen? There is call premium. The company has to pay call premium, right, to compensate for that missed opportunity. The call premium is usually just 1 more year's coupon payment, 1 more years. So it's like an early termination fee. Early termination fee. Remember, these days, in the old days, when you get a cell phone plan, you have to sign up a contract, cell phone plan was a 2-year, at least like 2-year binding contract. These days, you don't have any binding contract. You can change the cell phone plan whenever you like. But even about 10 years ago, the cell phone plans uh, were came with like 2-year binding contract. And if you early terminate the contract, right? The party that breached the contract is responsible, right? Accountable for that breach of contract. So they had to. So in other words, you cannot just breach the contract out of blue. If you early terminate, you have to pay the penalty, early termination penalty, right? So just like that, um, if they call the bond, uh, they pay you 1 more year's coupon interest as the uh, penalty for early termination, which is called call premium. Okay, now, so let's take a look at this example. So then, if that's the case, how do we value a call bond, right? So how do we? So let's take a look at this timeline. So the bond has 10-year maturity, right? Bond's life, 10 years. Currently, you're in year 2, at the end of year 2. So you've been collecting coupon payments until year 2. And the call protection period is for the first 6 years. First 6 years is the call protection. That means you have 4 years left until the end of call protection. From year 6, the company can call the bond. And how do you value the bond? Now the valuation, normally the valuation would be from year 2 through year 10 if you're in year 2, right? But because the bond can be called anytime after year 6, you cannot use this 8 years as the timeline. You'll have to use this as the timeline. Okay, so you will use only 4 years as the timeline, and your maturity value will be not just $1,000, but 1 more year's coupon payment, which is called premium. Okay, so let's take a look at an example. And then next, past, what this means is as the time nears the maturity, the likelihood of the bond being called will go down. Okay, the likelihood will go down because it's there's no point in calling the bond. Okay, I'll explain further. I'll come back to that and explain further. Okay, so let's take a look at this example. The Northern Timber Company is issued a $1,000 25-year bond 5 years ago. So that was 5 years ago. So the timeline left is 20 years, right? The bond has a call provision that allows it to be retired anytime after the first 10 years. The call protection period is the first 10 years, but that was already 5 years ago, right? It was issued 5 years ago. So how many years left until the end of call protection period? 5 years left. So our timeline is going to be 5, right? With the payment of an additional year's interest. That's the call premium, right? Interest rates were especially high when the bond was issued. Okay, at the time. Its coupon rate is 18%. That alone is already telling me 18% coupon rate means prevailing market rate must have been very, very high, about 15% or whatever. Interest rates on the bonds of comparable risk are now 8%. What does that mean? It means this is the discount rate, right? So think about it. One thing you can tell is that the is it going to be a premium bond or discount bond? One thing you can tell. It's going to be a premium bond. It's going to be a very, very high premium bond. Why? Discount rate is 8%, coupon rate is 18. Right? That's going to be a very, very high coupon rate, right? It's more than twice the discount rate. Such a bond will be, think about it, if on average you can earn 8% these days in the market, but this bond is paying 18%, who wouldn't want that bond? I will put my money into such a bond, right? So what is the bond worth today? So, this is also a two-part question, right? Part one, value. What's the bond worth today? So that is, valuing it as the call bond. This, part two, what would it be worth if it didn't have the call? Value it as a regular bond. Okay. So I set it up here, already, but something is. You may notice. You should spot that something is wrong there, and I made something deliberately off, and you should be able to spot it. But let's do this on Excel. Okay, I'm gonna stop this and stop sharing that, and I'm gonna share Excel. Alrighty, here we go. First, let's coupon rate is 18%. Let's just continue to use this one, 8%. So each coupon payment must be $90. Time left to end of the call protection is 5 years, right? And then currently the comparable bonds are paying 8%, right? Okay. So periodic rate will be 4%. But here, it already gave you the answer, but it is not correct answer. Why? Because this is not callable bond. If you do it as a callable bond, what do you need to do? You will have to make an adjustment. What is the adjustment? The face value, right? In the original example, it was only the face value, but look, you get not just $1,000, but you get one more coupon payment, and the coupon is 18%, right? So I will adjust the face value like this. Face value is already 1,000. The face value is 1,000. So if I multiply it by 1 plus B8, which is 18%, that's going to give me 1,180. 180 is one more year coupon payment. Isn't that right? So that's the call premium. So you hit enter, comes to 1,527.15. That's the call bond, right? Valuing it as call bond. Now, if it was a regular bond, what's it going to be? If it was regular bond, so let me insert another one, another row, and then I'm gonna copy all and just make this I don't know why. Oh, that's not dollars. Or just general. Time left is not 5 now. Then time left will be 15 years, isn't it right? Because, oops, what happened? 'Look, it was 25. Let's go back to, let me quickly go back to, it was 25 25-year bond 5 years ago. Okay, so 20 years left, right? It's 20 years left. 20 years left, so 40. It's not dollars. Percentage, again. Okay, then all you need to do is simply, I'm going to copy this and make an adjustment. And the adjustment is what? Instead of this, just use 1,000 as the face value. Then this should be the price of this bond, right? If it is a regular bond, right, with 20 years left. And that makes sense because 18% interest is not something you can earn these days. That's a fantastic interest rate, phenomenal interest rate. In the days when average market rate is 8%, right? So think about it. You're getting, like $180 every month for the next 20 years, and every $180 every year for the next 20 years. That alone is worth a lot, right? Okay. And if you have noticed, I said, you should be able to notice what was an error that was deliberately made there. This was the error because in that slide, in the PowerPoint, you will see this is 10. Cannot be 10. It's 5 years because only 5 years left until the end of call protection period. All righty. So that's it. That's it for today. So I'm gonna see you guys in the next lecture. Stop recording.